You see it at the pump, you see it at the food cost, and the second time is the roll-off. The roll-off is $47.5 trillion out of the $9 trillion.
Hi, my name is Judy Raneri, and I'm the Senior Portfolio Manager of the Gabelli U.S. Treasury Money Market Fund. So once again, the debt ceiling is in the news and is causing concern for markets and investors. And as Congress continues to fight over whether to lift the limit or not, we have to wonder, why is history repeating itself? We've raised the debt limit 78 times since 1960. What makes 2023 any different? So where are we now? The current size of the debt limit is $31.4 trillion, last raised in 2021. The current ex-date will fall within the first week of June, consistent with Treasury Secretary Yellen's best estimate date, and taking into consideration the $88 billion in extraordinary measures the Treasury still holds available. Now, the most discernible signs of stress that we've seen of late since raising the debt limit came into question continues to show up in the Treasury bill space. Specific maturities that fall around the ex-date, specifically June 1 through June 13, have dramatically cheapened, trading anywhere between 5.60% to 5.80 approximately, 120 basis points cheap relative to T-bills maturing early July. Outside of that sector, we really haven't seen much signs of distress. As the debate continues, there are three potential near-term outcomes. Although the specific path to a resolution is difficult to predict, it will likely hinge on just how hard each side of the aisle holds their ground more. The first would be the ceiling is raised without any associated spending cuts. Number two, the debt limit is increased alongside modest cuts to government spending. Or three, Congress temporarily suspends the debt limit until a later date in the year. In any of those scenarios, it's likely the process will draw out to the 11th hour. As we sit and watch the debt ceiling debate continue, we are left to wonder, what will happen if they don't reach an agreement? And if that's the case, both the Treasury and the Federal Reserve is expected to take responsibility. No one can really truly predict just how the mechanics would operate, given this would be unprecedented waters, but a contingency plan put in place in 2011 when we faced a very similar down-to-the-wire scenario would most likely be followed. To summarize the plan, there would be no default on Treasury securities whatsoever, those maturing and those owed interest. In return, the Treasury and the Fed would delay paying other obligations such as Social Security, Medicare, and to our military. Not the best alternative, but it is an option. The economic effects of such an unprecedented event would surely be catastrophic, unfortunately. Since a default has never happened before, it's hard to say definitively what it will look like. However, knowing the Treasury market is the bedrock of the financial system, the impact would be hard. Several things would likely happen, none of them positive. We would have credit downgrades, more tightening of liquidity and monetary conditions as well. Dollar weakness and a recession would be all but certain. That being said, ultimately, we strongly expect a compromise will be met. The debt ceiling will be raised, or at least suspended, and the Treasury market rates will be readjusting itself, because the consequences that would occur across all markets from inaction should provide incentive for both sides of the aisle to reach an agreement immediately. Thank you.